If there's one thing that I've learned during my time as an investment professional, then it is that growth is the most powerful driver of investment returns. Some of the best performing stocks of the last decade made their investors rich because they went through phases of explosive growth. And this is when investors made life-changing returns. I'm talking about companies such as, Nvidia, Palantir, or Tesla. But let's be honest, most of us probably missed the ideal entry point on those stocks. This is why in this video, I want to cover 5 high potential stocks where the timing might just be right. But before we get started, let me just explain how I picked these stocks. I looked for companies that are hitting a real sweet spot. Companies on this list have strong double-digit revenue growth, which are backed by real fundamental market tailwinds, and all of those stocks have a scalable business model. And finally, all of those companies have enough runway to multiply in value. And with runway, I mean still enough room to grow to multiply their enterprise value by 5x or more. Not just the next 10%, but real upside potential. Before we get started, let me just give you the standard disclaimer. This is not financial advice. So let's dive right in. First up on the list is SentinelOne. SentinelOne specializes in AI-driven endpoint protection. It basically helps companies to detect and stop cyber threats faster and better than traditional methods. And cybersecurity is a very attractive market, which has helped SentinelOne to grow its revenue with a 4-year CAGR of 72%. Very impressive. But the cybersecurity market is also very competitive. SentinelOne competes with competitors such as CrowdStrike or Palo Alto. Also, SentinelOne is still a very young company, which is not profitable yet. Let's move to SentinelOne's valuation. SentinelOne is currently valued at 5 to 6 times EV sales at the time of recording this video. If we look at the valuation of the largest competitor in this space, CrowdStrike, this one is valued at 25 times sales. This is 5 times the valuation of SentinelOne, despite SentinelOne having higher growth rates than CrowdStrike. This looks like a pretty asymmetric risk-reward setup for me. High upside with limited downside, which could make it a worthwhile bet for some investors. Moving on to our second stock on the list, which is Confluent. Confluent provides a technology that allows real-time data streaming. To put it simply, Confluent helps companies to process their data instantly. Whether that is a new AI chatbot that streams text data, or whether that is, video data for streaming services such as Netflix. And this is actually a very powerful trend. More and more companies want to move from data batch processing to real-time data streaming, which makes applications and operations smarter and faster. And Confluent has really been benefiting from this trend, as it has been growing with a 4-year CAGR of more than 40% over the last 4 years, which really proves the demand for its service. Just like most other players on this list, Confluent is not profitable yet. However, it has a solid gross margin of 70%, and its operating losses keep narrowing down as the company scales. And what is more important, the company currently has $2 billion on cash on its balance sheet, allowing it to keep investing and keep growing. Looking at its valuation, it currently stands at 5 to 6 times EV sales, which is approximately where SentinelOne stands. But it's definitely lower than the large data infrastructure players such as Snowflake or Datadog. So what are the risks? I mean, of course, the competition is fierce with AWS, Amazon, and Azure, Microsoft. But if real-time data streaming becomes the new norm, which it increasingly looks to be, then Confluent would be one of the major beneficiaries from this trend. Next up on this list is PDD Holdings. This is likely the fastest growing e-commerce platform out there, with a unique competitive advantage. PDD Holdings is the company behind the 2 brands Pinduoduo and Temu. Pinduoduo is actually a well-established but still growing e-commerce business in China. And Temu is the arm that is responsible for aggressive international expansion. And this has been working very well. The company has actually grown with a CAGR of 50% over the last 4 years. And despite this growth, the market is currently valuing this company at 9 to 10 times EV/EBITDA. And we're talking about a company that has consistently reached a top line growth of 30% plus and EBITDA margin of 20% plus, which makes it a rule of 40 business. But don't get me wrong, I'm well aware about the current regulatory uncertainty around China. However, it seems to me that the negative investor sentiment surrounding China has bottomed out in 2025. But I guess only the future will tell. Next up on the list is GitLab. GitLab is a DevOps platform that helps developers to plan, test, build, and deploy code faster. It basically helps developer teams to ship software faster and with fewer errors. Think GitHub, but more sophisticated. And GitLab has been growing fast. Over the last 4 years, it has been growing with a CAGR of 49%. But competition is fierce here too. The elephant in the room here being Microsoft's GitHub. But GitLab was really able to differentiate itself, being, more open and integrated. Enterprises prefer GitLab over GitHub because it's more flexible and also for compliance reasons. Valuation-wise, GitLab trades around 8 to 9 times EV to forward sales, which is not cheap, but within a reasonable range given its high growth and expanding market. However, the key question for investors will likely be if GitLab will be able to continue to carve out market share versus its, more dominant competitor GitHub. But if it can, it could be a nice compounder for the next 5 to 10 years going forward. And the last stock on this list is Global E, a company that facilitates global e-commerce. It helps e-commerce brands sell to international customers by helping them with, local payments, customs, duties, or shipping. And this is actually a very large addressable market. Global e-commerce is still growing at double-digit rates. And for many e-commerce brands, international expansion is the #1 priority. And Global E's business model is based on transactions, so it gets a cut for every transaction that is made, which makes it a very scalable business model. And that has helped the company to grow over the last 4 years with a CAGR of more than 50%. But recently there have also been some headwinds for Global E. Tariffs, deglobalization, and broader consumer uncertainty have led to a sharp pullback in the beginning of 2025 for the stock. So now the stock is currently valued at around 5 to 6 times trailing sales, which is far below what other SaaS and fintech software companies are valued at with similar growth rates. This stock gives investor exposure to a secular trend, and also after the recent pullback at the beginning of this year, the company's risk-reward profile seems to be a lot more attractive than a year ago, making it an interesting opportunity for potential explosive growth. So that's it, the list of high-growth stocks that I think are still early in their journey and have huge upside potential. Let's quickly recap. We first talked about SentinelOne, an AI cybersecurity player. Afterwards, Confluent, which is a company that provides real-time data infrastructure. And then we talked about PDD Holdings, an e-commerce platform at deep value currently. GitLab, which is the DevOps platform for the cloud area. And finally, we talked about Global E, which is a cross-border e-commerce provider now at an attractive discount. And if you find this information helpful, please don't forget to like and subscribe the video below. And don't forget to let me know in the comments below which of those stocks do you think have the most upside from here. And also, if you're interested in beaten down stocks that are currently at an interesting entry point, you should check out my video up here. Other than that, thank you for watching and see you in the next one.